oil and mobility. Historically, mobility and GDP have been synonymous. If you take a look at this chart, you can see how mobility and oil consumption has developed over years, with both of them indexed to 1970 equals 100, okay? So you can see after 1970, oil consumption rose very quickly in the blue. First oil shock in the red, consumption falls, vehicle miles stagnate. Very quick resumption of oil consumption growth into the second and second oil shock. There's two recessions here, that purple line, although it looks like one on paper. And then we have that long sloping thing in the middle, right? Anybody know what that period's called, since it's actually on the graph? I feel like Mr. Professor now. Right? That period is called Great Moderation. From the time OPEC threw in the towel in 1984-ish up until about 2005, right? This is the Alan Greenspan period. And during this period, oil consumption both grew and vehicle miles grew as well in the US as elsewhere, right? This is an era of overhang of supply. And we can go back, if you recall BP's chart with that big excess capacity, right? That excess capacity is created in the purple line, the second oil shock. The Saudis keep a high oil price. Lots of capacity comes online. Vehicle efficiency improves greatly, and you can see that there. And all of a sudden, we had an overhang in 1984 equal to 25% of consumption. And it took us a generation to absorb that, okay? So oil prices were low throughout that period. That period ended in about 2005, 2003, depending on how you count it. Stalls out there at the top. And then we go into the second Great Recession, which is the third modern oil shock, and immediately in the Arab Spring into the fourth modern oil shock. And you can see that, in fact, from an oil and vehicle miles traveled perspective, the period after 2007 looks a great deal like the period after 1979. We can see this in another view. This is from D.S. Short. D.S. Short does great graphs. There's some people just great graphers out on the internet, and he's one of them. This is the civilian non-institutional population, so I guess you're all institutionals here. No, you're really not, but not that kind of institution, age 16 and over, and his population-adjusted vehicle miles. You can see that vehicle miles traveled peaks in 2005, not 2007. It peaks with the oil supply in 2005. That's when the oil supply stalls out. And it continues to decline to the modern day, okay? So that's a society who's significantly losing mobility. So if mobility is growth, then it's also losing growth. And you can compare this period to the first oil shock, which is the first little hump, came and went pretty fast. Second oil shock, by comparison, came and went pretty fast. And this one, which is just bending the curve down without relief, okay? This is also true for peak car ownership, which occurred in 2006. Again, it predates the recession. And you may say, well, that's because people are retiring, changing demographics, seniors don't want to drive. No, that's not true. If you take a look, seniors have become much more likely to buy cars than young people. Then you say, well, then it must be that young people don't want to drive, and that's not true either. If you take a look at the left, this is from a study by Michael Sivak from the University of Michigan Transportation Research Institute. Michael's an indispensable resource for these sorts of things. They did a survey of the employment status of people without driver's licenses. And what they found was that only less than 19% of people in the survey aged 18 to 39 had full-time jobs. That's a horrible number. That was such a bad number. I went back and forth with Michael like 4 times on email going, you're sure, you're sure, you're sure? Is the sample right? It can't be right. I mean, there are different ways to interpret it, but there's very few ways to interpret it that's charitable. Similarly, the Highway Data Loss Institute, which must be just a fantastic employer to work for, said, I'm being a little facetious, they actually have good data, concludes from one of their studies that unemployment represents 80% of the reason why young people are driving less. So driving and employment are related. If you live in the US outside of New York or Washington, DC, or maybe San Francisco, then you know that if you want to be up and about, then pretty much you have to have a driver's license. And it's been that way for a long time. So this is not particularly surprising, other than the fact that in the press they've been saying something else. And we can see evidence of oil price pressures on behavior. So here's again from Michael Sivak. you can see that average new car mileage has actually increased faster than CAFE standards. So that means that the consumer is actually demanding cars more efficient than those required by law. That would be an indication of price pressure, right? So it's not an involuntary, it's a voluntary thing. On the other hand, if you see the chart to the right, we see new annual rate of improved mileage in new vehicles, and on the bottom is U.S. oil consumption. So if oil consumption is falling, that usually reflects pressure, oil price pressure, and we see increasing new vehicle mileage. When oil consumption is rising, we tend to see that pressure taken off. So the answer is people prefer overall, as we pretty well know if you live in suburbia, that people prefer bigger, more powerful cars if they can afford them. Okay, so when the pressure's on, people get smaller cars. If the pressure's off, they get bigger cars. And the effect of efficiency mindsets on consumers fade pretty quickly. So 12 months, 24 months is a long time. People can change their behavior during that period. All right. It's not just cars, it's also airlines. U.S. commercial airline departures are 16% below their 2005 peak. Passengers are not down that low because they've consolidated into larger aircraft and increased load factors, but departures are off. And they are 30% below their trend line. So if you go to LaGuardia or JFK, 1 in every 3 planes that we would have expected to see, even accounting for the recession, are not there. That's a big number. All right. So it's not just cars, it's other sectors as well. This is U.S. consumption of different kinds of products. Ethane, ethylene, these are derived from natural gas liquids, of which we have a lot, and you can see the consumption is up 72% since 2005. So that's a whopping amount of increase, which just says if you have cheap energy or fuel, you tend to use cheap energy or fuel, and we have. There's been considerable substitution in petrochemical and industrial processes. On the other hand, if you take a look at diesel fuel or gasoline, those have barely budged since 2005. Our efficiency gains in vehicle miles traveled divided by oil and gasoline use is not great. Our efficiency gains, if you divide how much we've traveled and how much gasoline we're using, is not very good. It's 1.5% since 2005. But people are holding on to their cars. What they're willing to give up is jet fuel, heating oil, and other stuff, distillate to power. These have been largely taken out of use in the United States since 2005. What has remained, what people are struggling to hold on to, is their driving habits, okay? Because that matters, because if you can't drive, you can't work. Not in New York. If you can't take the subway, you can't make your presentation in New York, but okay. So this all suggests that we are short on oil, that oil remains expensive, and that expensive oil is preventing the economy from operating the way it has traditionally been accustomed to do so. Let's talk about the oil majors a little bit. Oil production has faltered, even as capex has soared. The oil majors here, just for the record, are British Gas, BP, Conoco, Chevron, ENI, Oxy, Petrobras, Shell, Statoil, Total, and Exxon. Okay, these are the primary traded public companies. So their production is exactly where it was, crude oil production is exactly where it was in 2000. In fact, it's down from where it was in 2008, 9, or 10. But their capex is up by a factor of 5, from $50 billion to $262 billion during that period. That's phenomenal. That means, in nominal terms, the productivity of capital has fallen by a factor of 5 over a decade. Okay, that's a phenomenal unwind of an industry. Now, the way we've managed to compensate, what we have done, and it's reflected broadly, this is from Barclays, is that we've increased capex every year by a lot. For, capital expenditures. So capex, in this case, see, this is where I get into trouble, because we use these things as though, and then everybody's clueless, but that's good. If you throw things at me, then that's probably too much, but raising hands, okay. So capex is capital expenditures, what we would expend on things like factories, refineries, that sort of thing. Now, in our parlance, we use upstream spend, which is like capex. But the reason is that if you go out with a drilling unit, you rent a drilling, so Shell rents a drilling unit from Transocean, okay? I guess BP rents it from Transocean, but that's a different story. So they're paying $1 million a day for this unit. Now, that's a rental charge, right? They're not getting an asset for that. That unit is going out and drilling a well, completing the well, and getting it all done. But it has the nature of being a capital expenditure, right? It's what you do to prepare a field for production. So it's treated as a CapEx item. It's an upstream spend, even though technically you don't really get an asset as such necessarily for it. And the second thing is you might write it off as an expense if it's a dry hole. Okay, so if it's an exploration cost. But we treat those as capitalized expenditures because of the cost of finding and developing oil. So I tend to use CapEx here. We're talking upstream, which is finding and delivering oil, not refining it, not moving it around, not selling it. Okay, so I'm using CapEx and upstream spend as the same thing, even though they're not entirely. Okay, it's just a convenience, and in the industry we're a little bit loose with those terms. All right, so CapEx had been going up and up until recently, last 6 months. People thought, well, CapEx will continue to do very well. Okay, we've been on this trajectory forever, and we're just going to get more and more money out of this. Now, why is that? The reason is that in a demand-constrained model, for those of you who took economics, price equals marginal cost, right? So if my costs are going up, the price will also go up, right? That's a demand-constrained model. So if it costs me more to get oil, big deal. The market will recognize that at some point in a demand-constrained model, not in a supply-constrained model. In a supply-constrained model, the price goes up to a price that's very similar to the monopoly price, after which you really can't raise it because that marginal consumer would rather do with less than pay more. They will not recognize your marginal costs. In that model, you get to a price, and after that level, there's significant resistance from the consumer moving up off that price. That's the supply-constrained price, okay? If your costs continue to come up underneath you, the consumer won't recognize it, right? This is implicitly a demand-constrained CapEx or spend forecast because it says, oh, spend can go up for $1 trillion a year. Sure, we can spend $1 trillion a year looking for oil and gas. The global economy will accept that. Right? Whereas you start saying, well, gee, you know, how much will the global economy really accept? And actually, that number is calculable. Okay. So in addition, it is also true that some sectors have done very well. We monitor subsea hardware sales for FMC. It's the primary vendor. And some have done really well. The first 3 quarters, this is related to deep water subsea production. This is subsea production hardware. So if you produce oil from an offshore field, you have to have well heads and manifolds and valves and things on the bottom. That's this stuff. And that's done very well. But if we have seen profits have lagged in the industry as a whole because costs are rising faster than revenues, right? So E&P CapEx or spend per barrel has been rising by 11% a year, and that's net of technology improvements. So that's even including technology improvements. It's been rising by 11% per year, and Brent oil prices have been flat. So costs are coming up and revenues aren't. So a number of projects have consequently been deferred, canceled, or returned, and here are a few of them. There was a number last spring to last summer, and we've had 1 or 2 since then. But Chevron puts Rosebank. This is a UK project. Cost overruns on Castberg. This is a Statoil project in Norway in the Arctic. They haven't been able to make that work. Hadrian North, this is an Exxon project in the Gulf of Mexico. And BP's Mad Dog 2, which is really a kind of a field extension in the Gulf of Mexico. The Mad Dog 2 is a somewhat disturbing story here because they had approved the orders for everything and then canceled them a month later. And that wasn't thought to be that hard a project. Okay. So costs have outpaced revenues for 2 to 3% per year. And that means profitability is down by 10 to 20%. And that's pretty much across the board at the majors. What does that mean? So if my costs are going up by 2 or 3%, well, you say, well, that doesn't sound so bad. Yes, but my profits are 10 to 15% of revenues, right? So if my costs go up by 2 or 3%, that means my profits go down by 20%. So if they want to, let me put it to you this way. If your profits were 10% of sales and your costs went up by 2%, 2 percentage points, then your profits would then be 8% of sales, right? So you go from 10% to 8%, a reduction of 20% in profits. And that's exactly what we're seeing across the board in the oil majors. In fact, if you take a look, the vast majority of public oil and gas companies now require prices over $100, and more than half of them need over $120. The fourth quartile needs $130 or more. Almost all the oil majors are in this category. Okay? So that's to maintain their capex and to maintain their dividends. So this is a chart from Goldman Sachs. Goldman, what they calculated is what price do these guys need to be able to meet their capex obligations, their programs, plus maintain their dividends. Okay, because all these companies have dividends, and it's very important. These are widow and orphan companies, right? So you have to make enough from your projects to cover your costs, and after covering your operating costs, also cover their capex requirements, and beyond that, to cover the dividends that you intend to pay, right? Shell this past year, I think it was Shell, borrowed money to pay its dividends. That's not a good thing. Okay, so that's where this industry is right now, where their cost structure is not supporting their cash outflows in essence, okay? How are they responding? So here's this is a slide we did back in the summer, but a little bit updated. Shell here is sort of the litmus test. If you want to see what's going on in the industry, Shell is the company to watch. So during the summer, they decided to discontinue production guidance and focus on increased cash flow, because the investors were saying, look, that's great that you want to grow on everything, but look at how much capex you've put into this, and you guys haven't been able to increase production. And your oil prices aren't moving up. So forget growth, just give us cash. Demonstrate to us that you guys can generate cash returns, okay? So they discontinued production guidance, and they said they would focus on increased cash flow. Now they've said they're not going to do Alaska in 2014. This is partly for other reasons as well, but it reflects a general trend at Shell. And all the majors have announced divestment programs. Shell has announced a major divestment program to raise cash. Now, where do we go from here? So if your costs are rising faster than your revenues, the question is, does it make sense to sell your assets? Right? Does that solve your problem? Well, ordinarily, what you'd want to do if your costs were rising faster than your revenues is raise your revenues, but you can't do that because oil prices are dictated by markets. And cutting your costs becomes pretty darn hard because there's shortages in the oil industry as it is. So in essence, you get in a tough place. And so what they've done to generate cash, to placate investors, is to sell assets of various sorts to raise cash to pay dividends. But the question is this sustainable? Or how do we get back to some sort of level playing field? In this slide, we take a look at the legacy oil system from 2005. And if we take the view that it peaked in 2005, and that view seems to be still pretty good, then we would have anticipated that the oil decline would have mirrored the pace of the gain to the peak. So in principle, if you look at a peaking oil system, it should be symmetrical around the peak. So you approach the peak and leave the peak at the same pace, okay? If that were the case and 2005 were the peak, then we can see that the conventional oil supply did not decline as we would have anticipated moving off the peak. It declined a little bit, but not much. What happened in between there was that yellow area on the chart, right? That's the increment above what we would have expected to see in a normal peaking and declining system. How did we get that yellow chart, that yellow area? Well, we got that by throwing $2.5 trillion at the system, right? We put the whole system on steroids. And that's how we managed to hold that. Now, that strategy of throwing more money at it, and you could do that because oil prices were increasing, that strategy has run its course. You're not able to do that anymore. So the question is, what happens then from this level of production? Do we go back to the natural decline curve? And if so, at what speed? Or can we maintain this yellow line or run parallel? We're beginning to see some data coming in to give us some views on this. So E&Ps are cutting capex one after another. You can see Hess's capex is down 30% over 2 years. Shell is down 20% over this year. BG is down 6%. Statoil is cutting costs and taking these things down. So these capex compression, which we talked a lot about last summer, is now really beginning to hit home. Okay, and it's beginning to hit home in a big way. So a 20% capex reduction is a big deal. That's not a small reduction for a company the size of Shell. That's billions of dollars. So this is all historical. Let me show you forward-looking just for capex. So if you take a look at capex looking forward, the sort of industry consensus was that coming forward from here, capex would be broadly speaking flat. maybe up a little bit depending upon how you look. Keep in mind this is not everybody. This is just the oil majors, the listed companies we were talking about. This excludes the NOCs and like the U.S. independents. So there's a layer of companies out there. This represents about a third of total upstream spend. So if total upstream spend is about $700 billion plus or minus, this is 270. So broadly speaking, say a third. Now, if we take the views of that, up until recently, the industry consensus was that capex would be broadly flat, call it like that. When I presented a variant on this presentation at the Woodrow Wilson School down in Princeton in October, I had proposed that first gray line just beneath the flat line. And that at the time was considered a very radical, and I threw it in there, and I was like, wow, that seemed pretty radical and not very well justified, but okay, I think it's going to be something like that. And then if I start taking a look at what Shell's doing, that gives me that dotted line, the dotted gray line. Okay, and that's rolling off $80 billion in capex over the next 2 or 3 years out of 270. And if I take a look at Hess's experience, and Hess is about a year ahead of Shell, they're down 30%. So if I take a look at Hess, it's even worse. So right now, what we see is a significant pressure on capex emerging on the oil majors. This should not be assumed to be a capex on everybody the same way, but it is on the oil majors. Essentially, efficiency gains, historically, 1.2% per year for oil usage in what the Hungarians would call békeidők, or peacetime. It's normal. In stress times, 2% efficiency gains are possible. For 6 recent quarters, not in the last 2 quarters, but the U.S. has seen 3.8%. So probably, if you can't get more oil and you have to reduce oil consumption by 1.5% every year, and the max efficiency gain you can get is, let's say, 3, right? Then your GDP growth is going to be capped out around 1.5%, somewhere between 1% and 2%. And that's what we've seen so far. So that question is, can we break through of that or not? You know, in Europe, they certainly haven't. In the U.S., we're on the cusp of that. Is that because the Chinese are out of the market right now for oil, or is it because the U.S. is producing more oil? I don't know the answer to that. So demand-constrained models dominate thinking about oil demand, right? Those like BP. The data, in my opinion, have not supported these models in recent years. The data do fit a supply-constrained model. We do see that we appear to be oil short. You know, whenever there's incremental oil, it's quickly soaked up. Oil prices have not collapsed, despite the fact that oil prices should be on the razor's edge, and OPEC and all this sort of stuff. Nobody's nervous. They're all investing like it's going out of style. Actually, it is going out of style. So the data really doesn't support a demand-constrained model in general in the last several years. A supply-constrained approach may not be applicable if China falters for non-oil-based reasons. So if there's a readjustment for domestic reasons having to do with internal issues in that economy, if the U.S. short-term latent demand is sated, or if supply growth is very robust. For supply growth model to be valid, oil must be holding back GDP growth as an implicit element of model construct. Okay. So to conclude here, in essence, we are looking at a situation where oil may be constraining the OECD economies. I think it probably is. I think China will return to the markets. I think price pressures will return to the markets, and pressures will resume on the advanced economies because China is going to take its increment over a period of time. So with that, I'll conclude this part of the talk and happily take any questions that we can have.
Great. Thank you again very much. We have about 10 or 15 minutes for questions, and we would just ask folks to please line up and just ask questions from the microphone up to the side, just so that we can actually capture all of your questions for the video and the online audience. And it looks like we have a few. And again, if you could just please state your name, affiliation, and make your question a question as opposed to a statement, so we can get through as many as we can.
First of all, I'd like to thank you for a very stimulating talk. The data was just overwhelming, and I'd love to get the paper. So please, I don't know, give us the link somewhere so we can get it.
It'll be on. Jesse will have it. Yeah.
It's already posted.
Very good. Thank you.
Okay. There are many points that were controversial in your talk. I'm sure you know.
That's what I do.
That's great. But the primary one is that you didn't mention natural gas. Yeah. I mean, natural gas obviously has taken a lot of, especially in the United States, a lot of demand away from oil. So, so that somehow that has to be factored in your analysis. And I'll just leave it at that because, as I say, there are lots of interesting points.
Yeah, I mean, this presentation, as long as it is, it's quite a dense presentation. And if I had longer, I'd take more time. I only spoke about natural gas indirectly in that consumption of goods. You can the ethane, ethylene, that's a natural gas product. And in heating, the heating oil you can see is down. And a lot of that's going to be people swapping to natural gas. So, yeah, natural gas is there. We did a capstone workshop here about natural gas vehicles 4 years ago. If you're asking me whether we're, the U.S. is on the cutting edge of what should be happening there, the answer is no. But natural gas continues to be positive. But this is really about oil rather than gas.
Okay. Mark Rodovan, I'm here at Columbia. Question again is on supply, which is your focus. And my question has to do with the tar sands, which in Alberta are considered to be a Saudi Arabia. So you're talking about drilling expense and the capitalization of, E&P and so forth. Did your analysis really include the mining of, hydrocarbons and so forth?
Yeah. So if you look, the Canadian production there was included oil sands. In the last 7 years, they're up 1.2 million barrels, something like that. If you take a look at the Canadian Association of Petroleum Producers, CAP, they'll spot you about 150,000 barrels per day per year from the oil sands. The oil sands are quite expensive. They're right at the top of the cost curve. So there's some issues there. I don't have any controversy. I think that the increase which the Canadians are showing, which is to 3 million barrels or something by 20-something, I think that'll happen. The oil sands are developing pretty well, but they're not a resource that you can roll out 1 million barrels at a time. 150,000's good, 250,000's a really good year for them. They've had big years. Last year they did 450,000 barrels per day, but that's because there was a clustering of projects. So it's important, but it's not. You can't scale it at this pace that that would be optimal.
Could you comment on the supply side on two issues? One, with non-core assets being, as you said, being sold off. A lot of private equity money is moving in to develop that, so how that's hitting supply. The second issue is also the country-based oil companies like Pemex and the like. Yeah. I mean, Pemex in particular is now changing their constitution to bring spending in, and there's a lot of, I've worked with them, there's a lot in the ground because they've been capex starved for years. So how those two things are influencing your supply picture?
Yeah, so the private equity funds are just swapping out strategics, right? And it'll be a good time. This is a great time to be a private equity fund because if you count up the buyers, the strategic buyers for these major assets like Wheatstone and these other big plays that are big assets being sold. There's being sold $8-10 billion at a pop. Okay. Now, if you count up the buyers there are about 7 of them, right? There's the Saudis, the Qataris, the Kuwaitis, maybe. Then you have the 3 major Chinese oil companies. This is going to be a big change. I think the Chinese oil companies are going to be big time into this change right now. They're a little slow to recognize it because you have to be thinking more in terms of national priorities rather than rate of return priorities. But the Chinese will be big very soon, and that's going to have some interesting political tensions. We will have discussions in this room in the next 18 months on what if the Chinese buy everything. It's coming. And then maybe you have the Russians, Rosneft and Gazprom, maybe ONGC. You run out of buyers pretty quickly. And all these oil majors are going to be dumping assets at the same time. And there are not going to be any buyers out there. So suddenly you're going to run short on assets, and now you're going to say, okay, where can I find $8 billion? And you're going to find Carlyle and Texas Pacific Group and KKR and these massive funds now taking big positions at really bad prices from the oil majors because they're going to have to dump them just to raise cash. So, the oil majors are very slow on understanding what's happening to them because they don't use supply-constrained forecasting, right? So that's made them inherently optimistic. Oh, prices will rise. And they're not rising. They don't know why they're not rising. But now they're in a position as, we better sell something because our investors want dividends. Right, so there's going to be a point here where there's a fire sale. Yeah, if you're one of the big private equity funds, this is good. There's going to be some significant opportunities out there. So that's one. The other thing that's happening now, so that the fact that prices are not rising also affects the petro-exporting countries, the Saudis, the Russians, the Alaskans, and the Mexicans as well. Those guys, remember, those guys in the period from 2003 to 2011 made a killing by not producing any more oil. They made a killing just because prices moved up. So the Saudis today are producing what they were producing in 1979. but they're making a pile of money because the prices have gone up so much. Well, guess what? Prices aren't going to go up now. So if these guys want more revenue, they're going to have to increase production. And that's going to force them to liberalize these countries, like Mexico. But we will see more of this. This is why if you're an oil company, in my opinion, now you take the under, right? You take the Nigerias, you take the Mexicos, you take the Argentinas and the Russias, because you assume that the pressures are going to come your way.
Hi, Jared Anderson. I'm managing editor of Breaking Energy. I was wondering what your preferred oil supply-demand data sources are in your view of Jody, and are you bullish on Iraq, or what's your view of Iraq?
My primary data source is the EIA. I guess I'll leave it at that. I don't use Jody too much, but I do appreciate it. Iraq is underperformed. I mean, if you take a look at it, you know, there's U.S. and there's Canada, right? And you'd really think that Iraq would certainly have displaced Canada, right, at a minimum. But it really hasn't. I mean, it's 1.2 million barrels. U.S. oil supply growth in the next 12 months will be as much as all of oil supply growth in Iraq since Saddam Hussein fell, pretty much. So, you know, the Iraqis should be producing more. They certainly could. Will the politics sustain it? You know, it doesn't look like it's going in the right direction.
Bill Lowe with Third Corner Capital. It's an outsourced business development and corporate development firm. When discussing CapEx, you mentioned upstream spend and involving service and equipment rentals. What's your opinion regarding multinational oil companies partnering with these local upstream service providers, specifically in Western Africa, more specifically in the Angolan market? Have you seen appetite for investment into these local service provider companies, or is this something where the level of risk is a bit high, given that these local companies are less so institutionalized?
Yeah, pass. I'll be honest with you, I don't know about partnering in Western Africa, so I'll just have to pass on that. I mean, I think oil companies will do what they can to get, you know, who is it, Christophe de Marguerite? I think he was here in this room too. And he said, oh, wouldn't it be great if all the oil was in like suburban Paris or stored in nice places, you know, in Pennsylvania, and we get easy to get to. But the truth is that most of the oil nowadays is in difficult to get to places. The oil companies, that's what they do. You know, they find ways to get it out of difficult places, and there are different ways of doing that. But they're, you know, that's a core competence for them. So
please join me in thanking Steven Kopits once again.
Thank you very much.